course, is things are much settled overnight while we were away for a trading holiday on account of the Dussehra. So it's some bit of respite, at least that is what the GIFT Nifty seems to be indicating this morning.
So Aisha, look, what happened on Monday was actually brutal for the mid and the small cap stocks. It's like saying the back of the mid and the small cap space was broken. Now, nobody is surprised that the selling in a sense has emerged, and selling has emerged at a time when global cues in a sense have been slightly sticky, but everybody is surprised with the quantum. Now, what happened on Monday? Well, it appeared when the selling was so intense that there would be a very large institutional selling. And let's first establish the quantum of selling. That's the kind of selling what we have seen. 3 to 5% decline in 1200 stocks, 5 to 10% decline in 650 stocks, and a 10% decline in 36 stocks. We're looking at the broader market here. So that's the quantum of selling what we saw. So I'll first address the mid-cap space. Now this quantum of selling is not unexpected, but the composition of stocks I think were very universal in nature. So market did not differentiate between good and the bad stocks. As you walk into trade this morning, the bulls certainly will breathe a sigh of relief that Monday's selling was not in a sense ignited by large FI selling or DI selling, and thankfully global cues are calm. They've not reversed, but they are calm, which means that you may see perhaps a contained move in the market. But in my book, the best strategy in this market, Aisha, is that you just wait it out. And I continue to maintain that no action is the best action in this market, because you may be having some green on the screen in terms of the global setup, but I don't think the global concerns about macros, about the geopolitical concerns, the spike in crude, we are not out of the woods. So why do you want to buy the first fall? Because you want to buy when there is
more meaningful.
When there is visibility or when there is a valuation comfort. So my suggestion and my view would be that you do not want to jump in right now just because markets have fallen. They will become attractive after a one-day carnage. Next couple of days, we'll know which way global setup is. If the global setup is good and supportive, then you can obviously relook at the market. But right now, I think you should preserve capital, keep the gunpowder dry. This market is finding resistance at the higher level. The leverage trades in a sense are reversing in the mid and the small cap space. So the time to do cherry picking is not in the first fall. Time to do cherry picking is then when everybody is throwing up stocks or when valuations are attractive. So I don't think we are there yet.
Okay, fair enough. So despite that fall that we saw in the broader markets in particular, wait it out before actually dipping in. Let's also get in a sense as to what the global setup looks like this morning. You've got the major averages on Wall Street, which did manage to end in the green. There's been a lot of strong corporate earnings as well that fueled this move. So that's how Wall Street wrapped up. You've got the Asian markets. It's very mixed this morning. There's data from the Reserve Bank of Australia's monetary policy decision that's being watched out for. And the indicators when it comes to the US, the Treasury yields, they have become steady after slipping back below that 5% level. That was close to a 16-year high. So it crossed that level for the first time since 2007 and now seems to have retreated. And not just that, the price of Bitcoin, by the way, briefly topped 35,000 for the first time since May 2022. There's been positive sentiment of the Bitcoin ETF, and that perhaps led to that move. So just going by the rest of the globe as well, checking in on sentiment, and Nikunj, it seems like it's okay this morning.
It's okay this morning, but it's not great.
No.
And okay could become, it's sticky.
Yeah.
It's unpredictable. Now we may breathe a sigh of relief and say that, okay, the bond yields have not stayed above 5%. Bill Ackman, one of the biggest bond bears, they've covered their short positions. That is a clear indication that some of the global bond market callers and some of the smartest investors who mastered the art of going short, they're covering the short positions. But since the global environment is sticky and crude exactly is not moving the way you would have thought, you cannot call that right now. The global macros would be hard to predict. If global macros are hard to predict, that will have a sense and that will have an impact on the flows per se. So while globally between Monday and Wednesday morning, if you just map the last 48 hours change, thankfully no news development, nothing scary and ugly, and things are on the right side of the bulls. But I don't think you can say that convincingly that we could be in for more green on the screen, because I think volatility is back, and the mood in general is not risk on, it is actually risk off. It's an evolving situation which will have an impact on the way how risk assets would adjust, and for me that is the more meaningful part. And that is what I'll go back to that same point. You should not be in a hurry to buy the first fall. If at all, doing nothing I think is the best strategy. And the first real, canary in the coal mine for me would be what will happen to the risk assets in the next couple of days. If risk assets they start crumbling, then you want to stay away. If risk assets they stabilize, then we should take a fresh stock. But just because we've seen a bad Monday does not make it conducive for stocks to go up. See, Aisha, the large cap stocks oversold, so you will get a bounce. Whether you get it today, whether you get it later in the second half of the trade or tomorrow morning, I don't know. A tactical bounce is coming. So you have to examine that what happens after that. And typically when you see a carnage in the small cap stocks, it's going to linger for some more time. It will get over early, but it will linger for some more time because that space had almost become obese. It had become Humpty Dumpty.
The fall has just started.
Exactly.
On a net basis, we're still outperforming the broader markets as opposed to what the large
when I
caps
looked
are
at the
doing.
data on Monday evening, and my first question, becha kaun? FIs were buying, DIs was buying, becha kaun? Obviously, there was retail, and obviously there was some positioning, margin positioning which have changed, and that typically does not stop in one day.
Yeah, absolutely. Okay, well, lots to track, but you've got earnings as well, and the important one, of course, is going to be Axis Bank, purely because of its positioning amidst the other non-performing large private banking names, cases in point being Kotak as well as HDFC Bank. Look out for the credit costs because we're anticipating that they are going to remain under control. The margin pressure, what they expect going forward, cost ratios, guidance, and of course, the growth from Citi acquisition are some of the key monitorables that we're going to be looking out for, as is the case for Tech Mahindra as well, especially in the light of what the other large cap IT majors have done. There is a dividend expectation as well, but the demand in the telecom, the BFSI sector, new CEO, leadership, the kind of rejig that they're anticipating going forward from here, the Comviva acquisition scale up, headcount, deal trends, all of these monitorables is something that we're going to be looking out for. But I think Axis is going to be more important. For IT, the street already knows what's going to happen.
See, Tech Mahindra is a special situation stock, so you cannot rule that one out. Largely change of CEO. But has the change of CEO so far given any kind of great visibility in terms of whether earnings are likely to move? So far, the answer to that is no. Look at Tech Mahindra. Tech Mahindra in this year actually has done much better than what rest of the IT pack has done. So there is a bit of a hope trade which I think is there with Tech Mahindra. Let's hope that hope translates into real delivery. So Tech Mahindra, purely looking at the organizational restructuring, I think those numbers would be important. Then you got Axis Bank. If HDFC Bank, IndusInd Bank, or if ICICI Bank numbers are anything to go by, I guess for Axis Bank, it's going to be a decent quarter in terms of the banking numbers. Markets would like to know that, okay, where is the credit card business happening? How things are moving higher? What is happening to the cost of credit there? How things are moving on the cost to credit front. Then how exactly things are moving in terms of the insurance business. So there is a lot more news and a lot more guidance which essentially markets are expecting from Axis Bank in this quarter, largely for the non-banking business rather than the banking business. The banking business, that's a big piece for Axis Bank. That by and large for the sector per se and for the market standpoint, I think is stable. So can Axis Bank do what, let's say, ICICI Bank did 2 years ago? There is a case for it. So I think I was of the view that HDFC Bank will make a comeback post-merger, but it has not made a comeback. But you look at it in the same vein how Axis Bank and HDFC, IndusInd Bank have done. So the pecking order in the banking space, I think, is changing right now.
All right, that's the view coming in on results as well as the overall banking space. But let's also get in a